The comparison between Solana and Ethereum is one of the most commercially significant debates in blockchain technology, with billions in institutional capital allocated based on where developers build, users transact, and liquidity concentrates. At its core, the debate reduces to a fundamental architectural trade-off. Ethereum prioritizes decentralization and security at the expense of throughput. Solana prioritizes throughput at the expense of hardware requirements and validator set diversity. Solana can theoretically process 65,000 transactions per second with sub-second finality and sub-cent transaction costs. Ethereum mainnet processes approximately 15 to 30 transactions per second with 12-second block times and gas fees that can reach hundreds of dollars during congestion. This is not a close comparison on raw performance metrics. But institutional capital does not flow based on performance benchmarks alone. Ethereum has a 9-year track record without a single successful protocol-level attack, a validator set of hundreds of thousands of independent nodes, and a developer ecosystem that dwarfs every other blockchain. Solana has experienced multiple significant network outages in its history. The institutional evaluation of these two platforms requires weighting performance, security, ecosystem maturity, and investment thesis alongside the raw technical specifications. The performance comparison between Ethereum and Solana is misleadingly simple. Solana wins on every raw throughput metric. But Ethereum's comparative advantage lies in properties that do not appear on performance benchmarks: its security track record, its validator set size and distribution, its developer mindshare, and critically, its position as the canonical smart contract platform that all major institutional DeFi products, tokenized securities, and regulated financial infrastructure have been built on. Ethereum's network has never experienced a complete outage. Solana has experienced multiple significant outages since its 2020 launch, including a 17-hour outage in September 2021 and multiple subsequent incidents caused by validator memory issues, transaction flooding attacks, and consensus failures. For institutions deploying financial infrastructure on blockchain networks, uptime is not a nice-to-have feature. It is a baseline requirement, and Solana's outage history represents a genuine operational risk that must be explicitly modeled. Solana's performance advantage has driven its emergence as the dominant platform for consumer crypto applications, NFT markets, meme coin trading, and payment applications where sub-cent fees and instant finality are essential for user experience. These use cases have generated substantial transaction volume and fee revenue for the network, but they have also associated Solana's brand with retail speculation more than institutional infrastructure. The performance gap between Ethereum and Solana is architectural, not incidental. Ethereum was designed from the ground up for maximum decentralization. Any consumer laptop can run a full node, enabling hundreds of thousands of independent validators without barriers to entry. This design choice constrains throughput because coordinating consensus among so many independent nodes inherently requires communication overhead. Solana takes the opposite approach. Proof of history is a cryptographic mechanism that creates a shared time reference without requiring all validators to communicate synchronously, enabling much faster block production. But Solana validators require high-performance server hardware, and the network's performance targets mean that only a few thousand nodes can participate economically. This significantly smaller and more hardware-intensive validator set is one reason for Solana's better throughput and worse decentralization compared to Ethereum. The Ethereum Layer 2 ecosystem has substantially closed the performance gap from Ethereum's side. Arbitrum, Optimism, and Base routinely process transactions at Solana competitive speeds and costs while inheriting Ethereum's security layer. For institutions building financial infrastructure, this architecture combines Ethereum's proven security model with the UX characteristics required for applications that need high throughput and low fees. The institutional consensus is increasingly L2 first on Ethereum, rather than migration to alternative L1s. The ecosystem metrics tell a nuanced story that does not simply confirm Ethereum's dominance. Ethereum leads significantly in TVL, total value locked in DeFi, developer activity, and institutional infrastructure deployments. But Solana has built a remarkably competitive position in DEX trading volume, NFT market activity, and consumer-facing applications, narrowing the gap significantly from its near-zero position in 2020 to 2021. Solana's DEX volume growth is particularly notable. Protocols like Jupiter and Orca have achieved transaction volumes approaching Ethereum mainnet DEX volumes, driven by the low fees that enable frequent small-value trades that are economically infeasible on Ethereum mainnet. The emergence of Solana as a serious DeFi competitor, not just an NFT platform, represents a genuine shift in its institutional relevance. For institutional investors constructing diversified digital asset portfolios, the ecosystem data suggests treating Ethereum and Solana as complementary rather than directly substitutable exposures. Ethereum captures the institutional DeFi, tokenized securities, and high-value settlement market. Solana captures the high-frequency trading, consumer applications, and low-value transaction volume market. The addressable markets are different enough that a portfolio could rationally hold both. When the Ethereum ecosystem is viewed comprehensively to include Layer 2 networks, its dominance becomes even more pronounced. Ethereum mainnet plus its major Layer 2 deployments collectively represent approximately 70 to 75% of all DeFi TVL globally. Solana, despite its strong growth, represents roughly 10 to 12% of total DeFi TVL. The Layer 2 data is particularly significant for the competitive analysis. Arbitrum, Base, and Optimism are all Ethereum Layer 2 networks that compete directly with Solana on throughput and cost while providing institutional users with Ethereum security guarantees. The growth of these networks effectively expands Ethereum's capacity without requiring a fundamental architectural change to the base layer. For institutional investors, the TVL distribution is a useful proxy for where developer talent, user activity, and ultimately future fee revenue is likely to concentrate. The path dependency effects in blockchain ecosystems are strong. Protocols, bridges, and applications built on Ethereum or Solana create ecosystem lock-in that is difficult for competing networks to overcome even with superior technical specifications. This is why Ethereum's lead in TVL and developer activity is often described as a structural moat rather than a temporary first-mover advantage. The risk profiles of Ethereum and Solana are not just different in magnitude but different in kind. Ethereum's primary operational risk center on gas fee volatility for mainnet applications and execution risk in protocol upgrades. Neither of these has resulted in loss of funds or network unavailability. Ethereum's security track record is exceptional across its 9-year history. Solana's primary operational risks include network outages, which have impacted uptime on multiple occasions, and a validator set that is substantially smaller and more concentrated than Ethereum's. The network outages have generally been attributed to software bugs and transaction flooding rather than security attacks, and Solana Labs has made significant engineering investments to improve network stability. But the risk remains live and must be acknowledged in institutional due diligence. For institutions building financial infrastructure on blockchain networks, the risk hierarchy is clear. Ethereum's proven security and uptime track record commands a premium for applications where downtime or security failures carry significant financial or reputational consequences. Solana's performance advantages justify its use for applications where throughput and cost efficiency outweigh the incremental uptime and decentralization risks. The Solana versus Ethereum competition has produced one of the most productive technology rivalries in the blockchain industry. Ethereum's developer community has accelerated its Layer 2 roadmap significantly in response to Solana's performance challenge. Solana has invested heavily in network stability improvements in response to criticism of its outage history. Both networks are stronger than they would have been without the competitive pressure. For institutional investors, the practical portfolio conclusion is that both exposures are worth holding for different reasons. ETH provides exposure to the dominant smart contract platform with institutional DeFi, tokenized securities, and regulatory compliance infrastructure built on top of it. Sol provides exposure to the highest performance Layer 1 and the consumer crypto adoption curve, with a development community that has demonstrated exceptional product velocity. The size and timing of these allocations should reflect the institution's primary investment thesis and risk tolerance. Ethereum's larger market cap, deeper liquidity, and more mature institutional infrastructure make it the natural primary allocation. Solana's higher growth trajectory and performance advantages justify a secondary allocation for institutions comfortable with its incremental risk profile. The portfolio manager who holds only Ethereum is making a defensible decision. The one who completely ignores Solana is potentially missing a significant portion of the next wave of blockchain adoption.